Welcome to today's discussion. We're diving into Bernstein Private Wealth Management's outlook on the bond market for 2025, a piece titled Favorable Environment for Bond Investors. It's a fascinating read, and our guest is here to unpack the key takeaways. What immediately struck you about this report?
The core argument that despite near-term volatility, the overall trajectory points towards a favorable environment for bond investors in the coming years is compelling. It's a counterintuitive position given the uncertainty surrounding global politics and economic growth.
Exactly. The report highlights significant uncertainty, particularly with the incoming U.S. administration. How does that uncertainty factor into their positive outlook?
The report acknowledges the uncertainty, but argues that the broader trends moderating global growth, high starting yields, and declining interest rates are more significant than short-term fluctuations.
So essentially, they're saying to look beyond the noise. Let's talk about growth expectations. The report anticipates global growth falling short of consensus expectations in 2025. What are the key drivers behind this prediction?
The report points to diverging growth across regions. Europe, still recovering from the pandemic, is particularly vulnerable to external shocks. Geopolitical uncertainties, like potential snap elections in Germany, further complicate the picture. Conversely, the incoming U.S. administration's policies could lead to higher nominal growth and inflation in the U.S.
So we're looking at a potentially uneven global economic landscape?
Precisely. This unevenness will influence how much further interest rates fall in each region, with yields potentially falling more in Europe than in the U.S.
The report also discusses bond yields. While predicting short-term movements is difficult, what's their intermediate-term outlook?
They anticipate yields trending lower over the next 2 to 3 years in most regions. This is based on the historical relationship between central bank easing and declining yields. Furthermore, they expect significant pent-up demand from money market funds to flow into the bond market.
That's a substantial amount of capital potentially entering the bond market.
Yes, they estimate $2.5 to $3 trillion could shift from money market funds to bonds over the next few years. This increased demand should further support bond prices.
The report also analyzes yield curves. What's their perspective on the shape of the yield curve and what's driving it?
They expect yield curves to steepen further. Central bank policy influences the short end, while economic growth and long-term inflation affect the long end. The report highlights growing national debts worldwide as a key factor influencing long-term yields.
So the steepening reflects differing expectations for short-term and long-term economic conditions?
Exactly. They anticipate the steepest increases in the U.S. between 5-year and 30-year bonds, and in Europe between 2-year and 10-year bonds.
Let's shift to the credit market. The report notes that credit spreads are historically tight, yet yields remain near historic highs. How do they reconcile this?
They maintain cautious optimism. Investment-grade corporate fundamentals are strong, and high-yield issuers also show robust fundamentals. Falling rates should alleviate refinancing pressures. However, they caution that policy changes won't affect all industries equally.
What sectors are they particularly concerned about?
They suggest import-reliant industries, like retail, could face challenges. Conversely, sectors like energy and financials might benefit from reduced regulation.
The report outlines 7 strategies for investors in 2025. Let's go through them. First, get invested. What's the rationale behind this?
They believe investors should capitalize on the recent backup in yields as an entry point into the bond market. They warn against missing out on potential price gains as yields decline.
Next, extend duration. What does that mean in this context?
It means increasing the portfolio's sensitivity to interest rate changes. As rates decline, longer duration bonds deliver larger price gains. However, they advise a dynamic approach, adjusting duration based on yield levels.
The third strategy is think global. Why is global diversification important now?
Diversification across regions becomes crucial as central bank easing diverges, offering opportunities in different interest rate and business cycles.
Hold credit is the fourth strategy. Given the tight spreads, why is this still advisable?
Despite tight spreads, current yields are compellingly high. Careful security selection is key, focusing on strong financials and underweighting vulnerable sectors.
Strategy 5 is adopt a balanced stance. What does that entail?
They advocate for a balanced portfolio combining government bonds and credit assets, leveraging the negative correlation between them to mitigate risks.
Number 6, protect against inflation. Why is this important?
Given the risk of future inflation surges, they recommend increasing allocations to inflation-protected strategies.
Finally, complement with a systematic approach. What does that mean?
They suggest using systematic fixed income strategies that leverage predictive factors like momentum to enhance returns and complement traditional active management.
The report emphasizes the importance of navigating volatility. How do they advise investors to approach this?
They encourage investors to focus on broader trends rather than short-term fluctuations, positioning portfolios to capitalize on opportunities created by heightened volatility.
The report concludes that this is a favorable environment for bond investors. What's the key takeaway for listeners?
Despite the uncertainty, the confluence of moderating growth, high starting yields, pent-up demand, and declining interest rates creates a compelling opportunity for bond investors. The key is to be proactive and strategically positioned to capitalize on this favorable environment.
So it's about recognizing the long-term trends and acting accordingly.
Precisely.
Hmm.
It's about looking beyond the short-term noise and focusing on the bigger picture.
The report mentions the potential for a significant shift of capital from money market funds into bonds. How significant is this factor in their overall positive outlook?
It's a very significant factor. The sheer volume of capital waiting on the sidelines represents a substantial potential source of demand for bonds, which should help push prices higher. This is a key component of their bullish outlook.
And finally, what's the biggest risk to this positive outlook?
The biggest risk is probably a significant and unexpected surge in inflation, which could reverse the trend of declining interest rates and negatively impact bond prices. However, the report suggests strategies to mitigate this risk, such as increasing allocations to inflation-protected securities.
So a balanced approach, focusing on long-term trends and actively managing risk is key.
Absolutely. It's not about ignoring the risks, but about understanding them and positioning your portfolio to navigate them effectively.
This has been a very insightful discussion. Thank you for sharing your expertise.
You're welcome.
And thank you to our listeners for joining us. We hope you found this discussion helpful. That was a great discussion.